Good morning and welcome. You're watching Market Cafe on ET Now. That's Ankita Saxena with me and I am Harsh Saita. We're going to, over the next 1 hour, take you through all that's happening in global markets as well as all that's happened post-market yesterday in India. So we'll go domestic after that, taking you through specific company news as well as, of course, a quick results rundown and a possible impact on stock prices is something that you will get. So let's quickly take it to Ankita, who generally looks at global markets, and take a lowdown from her as to what's happening.
Good morning to you, Harsh, and good morning, everyone. Harsh, yesterday the markets were pretty lukewarm, very flat after the big run-up that we saw on Friday. It's primarily because the investors are now really waiting and watching out for key numbers that will be coming out from the US markets. So we are awaiting the April CPI reports. That's due on Wednesday, followed by the producer price index that is due on Thursday. Very important numbers that will pave the way for further rate hikes or not. That is something that we will be keeping an eye out for. The broad market index was little changed with a small gain of 0.05%. The Nasdaq Composite added 0.1% and the Dow Jones Industrial Average slipped 55 points. Largely flat, Harsh, and the European indices also started the trading week on a positive footing. CAC closed marginally higher while the DAX ended the session flat. The UK's FTSE was closed for the public holiday after the coronation of King Charles III. So it was largely a muted market, nothing much to talk about because the markets are really waiting in for the key numbers that will be coming out from the US markets.
Right, Ankita, and taking it straight to what crude currently looks like. A bit of a bounce seen in crude over Friday as well as over Monday, and we're seeing that both Brent as well as WTI are slightly higher. We're seeing WTI just below the $77 a barrel mark and Brent just below the $73 a barrel mark. So a bit of a relief coming through. Also, there seems to be some amount of view building up that it's not as bad as one would expect with regard to the US recession as well as with regard to how the economy is chugging along. So some bit of positivity there. Also, there is a bit of a build up with regard to that there is a possibility that crude prices have actually bottomed. So a little bit of both of those is adding some zing to crude. But at the moment, it's around that $73 to $77 a barrel mark, both WTI as well as Brent. So a bit of an uptick on crude.
All right, then let's quickly go across and see what are the events that we need to keep a track of. We have Raymond that will be issuing the, considering the issue of NCDs for the repayment of external debt. We also have Birla Corp that will be considering the issue of NCDs. Also, DCX Systems lock-in period opens on 55% of the shares. Plus, we have a lot of IPO action that's happening today. Mankind Pharma is listing on the bourses today. And we also have the Nexus Select Trust IPO that will be opening for subscription today, and it will go on till the 11th of May. That's the window where you can subscribe to this IPO. Also, in the corporate earnings, we have in the non-Nifty 50 companies, we have Rain Industries, 5-Star Business Finance, Latent View Analytics, we have Westlife Development, Lupin Limited, Chalet Hotels, SRF Limited, Raymond's, Godrej, Agrovet, Nazara Tech and Apollo Tyres that will be coming out with their Q4 earnings. Of course, in the global cues, we have the EIA short-term energy outlook data that will be coming out. And in other events to watch, we have Joe Biden who will be meeting the Congress leaders on the debt limit that is the talk point in the US markets right now. And also, we have Russia that will be stepping up on strikes on the Ukraine. So these are the global events and the events on the domestic front that we will be tracking very closely.
Right, we'll keep an eye on all of those, but let's begin with global macros then. According to a recent Federal Reserve survey, credit conditions in the US continued to tighten in the initial months of this calendar year. The report warns that banks' concerns about slower growth could lead them to make fewer loans, eventually accelerating an economic downturn. It also highlighted commercial real estate as an area of heightened risk that will draw more scrutiny from bank examiners.
And in an otherwise worrying scenario, US Treasury Secretary Janet Yellen continues to flag concerns over debt ceiling. reiterates that failure to raise the debt ceiling would cause an economic catastrophe. Yellen has been constantly flagging off concerns over debt conditions as the country edges dangerously close to the worst-case scenario, a potential US debt default.
And it's a slew of cautious comments clouding global macro outlook. We're looking at the Chicago Federal Reserve. Austan Goolsbee says that the central bank needs to be data dependent to determine further rate hike strategy. Recession is a possibility, he adds, as he reiterates that it is too soon to determine what's coming in Fed's June policy. He reiterates the need for Congress to raise the debt ceiling.
And in global earnings, payments giant PayPal has gone ahead and raised its full-year guidance post Q1 earnings that topped street estimates. The earnings beat largely driven by cost cuts and growth in e-commerce. Looking ahead, the company now expects to grow adjusted EPS by about 20% versus their earlier guidance of 18%.
And tracking news from the deal space, reports suggest that New York Times will receive a whopping $100 million from Google over 3 years as a part of a broader deal. The deal allows Google to feature Times content on some of its platforms.
And shifting focus to Australia, where the country's federal budget is projected to record a $4 billion surplus this financial year, which would be the first surplus in 15 years. Country's Treasurer Jim Chalmers has revealed that despite a $58 billion deficit projected in the March budget, the government has managed to log a surplus on the bottom line.
Well, that was a highlight on the global news coming through, but with that, we'll slip into a short break. We'll go check Asian markets right after. Good morning, welcome back. Thanks for sticking by. Let's quickly move on. Trouble continues for Go First as the Directorate General of Civil Aviation, the DGCA, issues a show cause notice to Go First. The airline is to file its reply to the controller in 15 days' time. At the same time, the low-cost carrier has approached the NCLT once more to fast-track its judgment on the moratorium as lessors are appealing to seize aircrafts. My colleague Samir gets us more on this one.
The problems of crisis hit Go First airline has further deepened. In the recent development, aviation regulator DGCA has issued a show cause notice to Go First airline and asked why the airline failed to continue their flight operations, why there is no safe and reliable flight operations, and the inconvenience that has been caused to passengers. So some burning question that has been asked to Go First, and most importantly that Go First has been asked to submit its reply within 15 days. And on the basis of reply, the AOC of airline will be maintained by DGCA, in the sense that if the reply isn't satisfactory, then it is very high chances that DGCA may suspend the AOC, which is Air Operator Certificate of Go First airline. To operate any airline, AOC is must. Without AOC, the flight operations cannot take place. And on the basis of Go First reply to DGCA, the AOC, the Air Operator Certificate, will depend. So this is a very high crucial time for airline to see whether their revival chances will continue or it will totally sink. In addition to this, we have also seen that Go First is looking forward for NCLT order. On May 4th, there was a detailed hearing on the insolvency process on the appointment of an IRP, and the judgment has been reserved by NCLT, which is yet to be pronounced. But on Monday, Go First once again approached NCLT for an early pronouncement of the judgment. So we see that from all the corners, the problem of Go First is continuously deepening, even to an extent that now Go First is struggling to intact their pilot, their trained manpower, their staff as well. And on the other side, the lessors are also pressurizing, are also requesting DGCA to deregister the aircraft which is registered with Go First. So now all eyes on NCLT order is when we talk about Go First, and they are looking that NCLT may come up with a relief order favoring Go First.
All right, then sticking with Go First, the airline's losses is proving to be the gain for competitors, including the largest player of aviation maker Indigo. Employees, including pilots of Go First that have not been flying since May the 3rd are seeking jobs elsewhere as rival airlines expand their operations. My colleague Sumit Chaturvedi joins in with more details.
Well, clearly GoFirst's loss is IndiGo's gain, primarily because GoFirst pilots, there are over 750 pilots, they were flying aircraft which were primarily 57 aircraft of A320 and A321, majorly Airbus A320 planes. This is clearly the kind of aircraft which is flown by IndiGo. IndiGo is flying close to 300 aircraft of this type currently. It's going to take the whole fleet further to 350 aircraft this financial year. So it has in GoFirst pilots, there is a clear pool from which it can hire. So it was earlier looking for pilots which were from different airlines or from the fresh pool, but now the pilots are coming from GoFirst. As we understand, dozens of these GoFirst pilots have applied for positions for IndiGo, and IndiGo has been expanding in a big way. Recently, it announced flights to Singapore and Thailand. It's majorly expanding in Southeast Asia, and summer plans also it has in big way, because the summer season is when Indians also they fly in good numbers. So it's going to fuel expansion of IndiGo. Remember, pilot expense is something which is clearly something which airlines bear, but here they are getting trained pilots from GoFirst, because GoFirst is grounded since May 3rd.
Right, thanks for that, Sumit. And quickly moving on, the ongoing turmoil with GoFirst has raised concerns about the health of the aviation sector. Listen in to what the management of Make My Trip had to say about what turbulence for the company means for the sector as a whole.
There could be short-term impact on pricing for sure. It tends to happen. It's just a very simple economic sort of principle. If there's a gap in demand and supply, that will definitely impact the fares. But that's more short-term. As things settle down, as the steady state sort of emerge out of the situation, and things settle down as well. In terms of just the overall industry outlook, Sumit, if you see, the outlook overall has been quite positive. If you look at the daily passenger numbers that are, sort of put out every day, there's already growth happening. The consumer sentiment looks pretty positive. People are traveling across, this is like a travel season time. So we haven't really seen any sort of, at least the consumer sentiment, still staying very positive. We haven't really seen that getting impacted. So, looks like overall outlook is pretty positive, and these kind of events that happen, they have happened in the past, and they definitely have short-term impact, but eventually it'll settle down.
Right, and less than a week after GoFirst voluntarily filed bankruptcy plea at the Delhi's National Company Law Tribunal, another budget airline, SpiceJet's operational creditor, has filed an insolvency petition against the airline. The petition was filed by Aircastle. The NCLT has issued a notice to SpiceJet on a petition filed by Aircastle seeking initiation of insolvency resolution proceedings against the budget carrier, and the next hearing is scheduled for May the 17th. However, SpiceJet spokesperson clarified that the notice was issued in normal course. There was no adverse ruling against SpiceJet. The court has recognized the fact that parties are under settlement discussions and they can continue to pursue the same, SpiceJet said.
Right, and Finance Minister Nirmala Sitharaman chaired the 27th meet of Financial Sector Development Council yesterday. She maintained that regulators must maintain constant vigil amid global challenges. This is what DEA Secretary had to say after the meet.
Coming from the global economy and global perspective, it was noted that maintaining financial stability, being on our toes to maintain the stability in our economy is a shared responsibility, and all the members will be working towards that. Beyond that, it was also noted that cyber security, as the economy and the different, especially the financial sector, is becoming more digitalized. A much higher level of preparedness is needed for cyber security of all regulated entities, especially the large regulated entities, systemically important financial institutions as well as the financial market infrastructure. Beyond that, it was also noted that as the union budget has announced, that unclaimed deposits and shares and dividends which are lying in the pool, there should be a drive should be taken by the concerned regulator, especially where the nominee details are available with them, though the nominees may not be aware of it. So in a time-bound manner, that activity to be taken. Wherein, or several cases wherein the nominee details are available but nominees have not come forward. Perhaps they themselves are not aware. Beyond that, the committee, the council discussed that in what manner the KYC process has to be simplified and it has to be streamlined for the needs of the digital India, which was one of the announcement in the budget.
And A. Mani Mekalai, Managing Director and CEO of Union Bank, believes that there will be no impact of higher interest rates on the margins and hopes to reach a 0.75% ROA by the end of FY24. Let's listen in to what he had to say.
On assets, we are hoping to, at least 25 is what we have given the date that it will be at 1. In the current financial, for the quarter, we were at 0.88 and for the year as a whole, we were at 0.69. We are just hoping that we will reach 0.75 at least at the end of the fiscal. Almost 50% of my loan book is covered by an MCLR, and so this is to be repriced once in a year. So out of that, just about 50% of them have been repriced during the current year, and going forward, the remaining 50%. If you look at even in as of September alone, I've got about 41 to 50,000 crores of my loan book to be repriced during the year. So I'm not seeing any reduction in my margin.
Right. Moving on from there, Invesco has cut food and grocery delivery platform Swiggy's valuation by 33% to $5.5 billion according to their regulatory filing. This is the second time that Invesco has slashed Swiggy's valuations in less than a year. The investor had reduced Swiggy's valuation to $8.2 billion earlier in April. Swiggy's valuation has been reduced by almost 50%, 49% from January last year in total, pegging it behind its peer Zomato. Remember, this comes at a time when ONDC is gaining traction.
All right, then with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we go stock specific. Welcome back here watching Market Cafe, and it is that time of the show where we get to all the stock specific news. First up, let's get some light on from PM Vasudevan, who's the MD and CEO of Equitas Small Finance Bank, whether they are working on the current account growth, which has been a bit of a challenge. Let's listen in to what he had to say.
So our deposit growth was quite robust last year at about 34%. And this year we continue to expect deposit to strongly grow, because we need around 25-30% growth in deposits to support an equivalent level of growth in assets. And so we are geared for that. And we have a sufficiently large number of branch network to enable us to mobilize the deposit required for business. In terms of the retail deposits, retail term deposit, RTD, we have done fairly well last year. It grew by about 25%, but this year we expect that to maybe even inch up a little bit more than 25%. In terms of the CASA, our CASA ratio is around 42% as of March 23. And it's going to be a struggle to help retain that through the current financial year, because you know that the interest rates on deposits have become very attractive. 1 year deposit attracts a rate of around 8%. So customers who have some amount of cash in savings and who are willing to keep it away for about a year or more would prefer to move it to a term deposit rather than keep it in savings.
Right, let's switch over to Aditya Birla Fashion and Retail. The Aditya Birla Group firm has entered into definitive agreements to acquire a 51% stake in TCNS Clothing, which owns ethnic brands such as W, Aurelia, Wishful, Folksong, as well as 11. Vamakshi joins in with all the con call highlights. Vamakshi, take us through those.
Well, absolutely. Yesterday, the company did hold a conference call with its investors as well as analysts, and some of the important takeaways that we have come out with is the fact that Aditya Birla Fashion and Retail has said with the TCNS acquisition, the ethnic wear portfolio is now complete, and they will now be focusing on scaling up the existing brands. Apart from that, they also highlighted the rationale behind this whole transactions, and they said that the vision earlier was to build a brand organically, but they did come across this opportunity, and they realized that building a brand of this scale would require at least 10 plus years. So on the back of that, ABFRL thought that it would be better to adopt an inorganic route, and that is why they went ahead with this acquisition. Now, as far as the vision ahead is concerned, 5,000 crores of top line is expected from the ethnic portfolio by FY27. That is what they're targeting, and a 50% or more could be expected from TCNS brands. Now, TCNS brands such as W as well as Aurelia can become 1,500 crores brand each, is what they've said. Tasva is seen as a 1,000 crore brand, while Sabyasachi, Tarun Tahiliani and others together could generate as much as 1,000 crores. Now, as far as the debt is concerned, the acquisition of 1,650 crores is expected to be funded by around 700 to 800 crores of debt, and in fact with this they're expecting the net debt to EBITDA ratio to climb up to 3 times, but however in the long term they are quite confident of bringing it down to below 2 times. Apart from that, they also are confident of returning to double-digit EBITDA margin in TCNS brands within a short period of time, and based on the current judgment, TCNS will also start being EPS accretive by FY25 or by FY26.
All right, then thank you for those details, Vamakshi. But let's quickly go across and get some perspective from the management on this latest development.
The above transactions will be one of the largest deals in the Indian fashion space. Way back in 2018, we had explicitly stated our growth strategy for the coming years to be built around ethnic wear, the largest segment in the Indian fashion space. Over these years, the company has made several organic and inorganic moves with an objective to build comprehensive portfolio of brands in this key segment. This deal will allow us to expand our existing ethnic wear portfolio into the largest sub-segment, which is premium women's ethnic wear segment, where the branded part of the segment is expected to grow at high double digit for years to come. This acquisition will be funded by incremental debt and internal accruals.
Right, Sun Pharma is also in focus on the back of a Morgan Stanley note. Vinny is standing by with all of those details. Vinny, good morning.
Good morning, and in the note mainly this specifically it's highlighting on the Revlimid which has been launched by the company in April 2023. What Morgan Stanley is highlighting that this would actually help Sun Pharma in terms of offsetting its near-term earnings headwinds, and for the medium term they see this being a few growth drivers as well, including the Foreto as well as some of the other drugs which could be a growth driver for the company. Sun Pharma has actually grossed a 2.35% volume market share for the week ended April 28th. So that is an important update coming in there as well in the note. And obviously the brand which is launched is net sales pre-generics were around $8 billion. So there's a huge market opportunity also that comes in for Sun Pharma. That is why Morgan Stanley is overweight on Sun Pharma, given a target price of 1,170 rupees per share, assuming that 40 to 45% of the price erosion, low single-digit market share. They expect Sun to gross around an 80 to 120 million in terms of the annualized sales from here with high margins as well. That is why they believe that this could actually offset any headwind in the near term that we could see coming in for Sun Pharma in terms of the earnings. And for the medium term also, this could turn out to be a few of the growth drivers with some of the other generic drugs.
All right, thank you for those details, Vinny. And moving on, we have all the brokerage notes coming in this morning, and we have Vamakshi joining us again in the studio, who has scanned through all the brokerage notes for you. So tell us, what are the stocks that we need to keep an eye out on?
Well, absolutely. Let's first start off with KFin Tech. We have a note that has come in from JP Morgan, and they've highlighted that the revenue growth was weaker this time around, but the company did manage to maintain its margins. Now, given the lower revenues from the domestic MFRTA business, the company has gone ahead and cut its FY24 and 25 PAT estimates by around 7%, and that is the reason why JP Morgan has actually maintained its neutral stance and in fact cut its target price from 320 per share to 310 per share. The next stock on our radar is Pidilite. JP Morgan has come out with a report now. After the company reported its numbers yesterday, JP Morgan believes that the revenue was a miss, and that was mainly due to the subdued B2B segment. However, the gross margins did recover. The demand narrative was cautiously optimistic, and the company is noting improvement in the rural as well as the semi-urban demand during the quarter. Now, easing of input costs should also expect the company to drive its sequential margin improvement. And on the back of that, JP Morgan believes that Pidilite, they've actually maintained an underweight call and given a target price of 2,150 per share. And lastly, we will be watching out for Exide Industries. Again, the company did report its Q4 numbers, and we have a few brokerages that have come on the same. JP Morgan has maintained its overweight call, target price of 225 per share, while Citi has maintained its buy call but decreased its target price from 265 to 240 per share. They are highlighting that in the fourth quarter, the margin was a miss on account of an inferior mix as well as the impact that came in from raw material inflation. They believe that stabilized lead prices as well as lagged impact of price hikes could impact the next quarter positively. And in fact, they also believe that the lithium ion cell manufacturing project is progressing as per plan. So largely, the brokerages are appearing to be a bit positive, maintaining their overweight as well as buy stances.
Right, thanks for that, Vamakshi. Let's quickly move on though. Pharma company Mankind is all set to list on bourses today. How does the listing alter things in the sector overall, and what does it mean for the competing peers in the sector? Srishti is here to paint a comprehensive picture ahead of the listing.
Well, yes, all eyes is on Mankind Pharma listing, and this time around the analysts are expecting for a positive listing given the fact the strong response that this particular IPO got in the large cap space. This is an IPO coming after a long period of time in the pharma space, and this time around we have seen a good response coming in with a total subscription of over 15 times, wherein the QIB portion was subscribed with the most of the enthusiasm with 949 times subscription for that particular quota. Other than that, the NII portion was subscribed almost 4 times, while the retail portion was subscribed 0.92 times. But nevertheless, the anchor investment was actually quite robust at 1,298 crores being raised through the anchor investments from the likes of HDFC Mutual Fund, SBI Mutual Fund, Axis Mutual Fund. All of these companies have invested in this particular IPO, and some of the MNC names as well, like BlackRock, Nomura, as well as Morgan Stanley into the list. So this particular IPO is expected to get a good response, wherein analysts are expecting that the listing could be at a premium of rupees 100 from the upper band of the price range, which is 1080, but they are expecting the listing to be around 1200 rupees. So all eyes on Mankind Pharma, but do remember that majority of the analysts have recommended for a buy in this particular IPO, which indeed got a good response. But looking at the valuations, because Nifty Pharma trading around 23 times, the Mankind Pharma IPO at the upper band is being valued at 29 times. So if this particular IPO listing is done at even almost a 10% premium, then the valuations can be stretched till 30 odd times. So that is all about Mankind Pharma. All eyes on that particular IPO listing tomorrow.
All right, then a good response coming in there for Mankind Pharma, and it will be listing on the bourses today, so we will wait and watch out for that. Moving on, Rajiv Thakkar, CIO of PPFAS Mutual Fund, believes that the banks are right now sitting on clean balance sheets, and it is an attractive business if they run well. Let's listen in to what he had to say.
So right now in India, we are in a period where banks have cleaned up their balance sheets. All the earlier corporate credit losses were cleaned up. Then COVID provisions and people have come out of COVID quite well. So today they are sitting on clean balance sheets. The market share shift from PSUs to private sector continues. Given that interest rates are higher, the CASA rates are, CASA benefit is coming in where these spreads can be higher. And we don't have the problems like excessive lending to commercial real estate or problems in terms of huge amount of bond losses and things like that. So I think in India, banks are quite well placed. I would think that they are trading at multi-year low valuation multiples, that is a space that we are quite excited about.
Right, we'll stick with the financials because Ravi Dharamshi, who is the CIO at ValueQuest, also believes that financials is the strongest sector in India at the moment. He sees a clear runway for the sector. Let's listen into his views.
Out of the $40 billion outflow that happened, $20 billion went out of financials. Now you just juxtapose it with the fact that US regional banking is facing a severe crisis. The larger banks are being called upon to support the smaller banks. And of course, yesterday Fed made a statement that, that was an exception. It's not likely to happen. But what that tells you is that elsewhere, there are problems created by the lending sector. While in India, it is the strongest sector. In fact, nobody talks about an asset quality deterioration or any of those things. All we keep discussing is, will there be an impact on the NIMs? Is the growth going to be high enough or not? And in fact, I find financials as the only place in the market where there is a combination of growth as well as value. Most of the places have growth, then the valuations are not in your favor. Or if the valuations are in your favor, then there is no growth on the horizon. So financials is the only place which has growth plus value and will be the first port of call for any foreign money that will be coming into India. And I think what will happen is maybe the second tier and the third tier rung in the financials will also start benefiting from this. So now we are witnessing probably some change of guard. We have already witnessed a change of guard in the large banks. Probably we are going to witness a change of guard in the large NBFCs as well. So some of the performing ones will probably get outpriced before they even come down.
Moving on, Baldev Prakash, MD and CEO of J&K Bank, gives the guidance on advances, deposit growth as well as the NIMs going ahead. Listen in.
Advances growth, we have given a guidance in our investor call, will be around in the range of mid-teens, 14 to 16%. We will be able to maintain this range of 14 to 15% in advances. CASA, we are having already 54% percentage of CASA, and which is holding for quite a long time. But out of that, we want to improve CA, and we have the expansion plan also for rest of India, mainly keeping in view the growth in deposits. We should be able to reach to 10% as far as deposit growth is concerned during this year. We have maintained NIM around 3.75 on it, if you see it on a consistent basis, 3.75 to 4%. On a conservative basis, I'm saying that we will be in the similar range as far as NIM is concerned. But you see, we have a lot of liquidity in investment portfolio, and that portfolio around 8,000 crore is now, I think we will be shifting it to the advances, and obviously that will improve our NIM. So on a conservative basis, definitely we will be maintaining NIM around 3.75 to say 3.90% going forward also.
Right, we'll stick with the financials. Sridhar Sivaram, who's the investment director at Enam Holdings, is overweight on financials as well, and he believes that banks are in a sweet spot right now. Listening to what he had to say.
There's a big difference between US banks and Indian banks, that we've always seen a very high rate. And if you just look at, say, mortgage as an example, barring the two COVID period when the mortgage rates actually fell to 6.5%, we've broadly been in the 8 to 9% range of mortgage for a very long time. The last time the mortgage rate fell below 7% or closer to 7% was in 2001. So actually we're used to a higher rate. So I think maybe the people who borrowed at 6.5, now that the mortgage rates have gone to say 8.5, they may have some issues. But even there, we think the tenure gets extended to some extent. So we don't see a big issue as far as financials are concerned. We are actually very bullish because in the last 5 years, all banks have cleaned up their balance sheet so well. Most banks have extra provision cover. Due to COVID, they had kept COVID provisions. And if you look at the financial numbers, I think the NPA numbers are far lower than what most banks had guided. So we think we are in a sweet spot right now. But it has to be watched carefully. As you mentioned, one of the corporates had issues yesterday. So you have to just watch the space carefully. We are quite bullish. We are overweight on financials.
All right. then Saugata Gupta, who's the Managing Director and CEO of Marico Limited, does not see a deflationary impact going ahead and adds that the volumes will be better this year on an annualized basis. Listen in to what they had to say.
I think if I look at annualized, I don't see any impact. There could be some, deflation built into our revenues in the first half, but the second half, as I said, that most of the pricing interventions happened in the first half, and we started taking price drops in the second half. So I don't see any overall full year any deflationary impact this year. All I can say is that for an annualized basis, this year will be better than last year, and we need to see how it pans out after that.
Right, and we also spoke with Keki Mistry, who is the Vice Chairman and CEO HDFC. He expects to see strong growth ahead as well. He also expects mid-teens to higher teens growth in FY25, in fact. So listen to those thoughts.
So I would say my sense is that you would see a strong growth in the year ahead. On a standalone basis, as HDFC is today with our existing distribution machinery, we would expect the mid-teens to slightly higher teens kind of a growth even next year. But when you move into a banking structure, because of the much larger distribution framework, the much larger distribution platform of the bank, the massive amount of under-penetration of housing loans amongst the bank customers, logically one would expect the growth numbers to be strong. Now, when you compare first quarter and fourth quarter, there's a bit of an anomaly because the first quarter of last year had the COVID impact. So you saw higher growth in that first quarter as a consequence of the fact that in April, May of 2021, there was an impact of the second wave of COVID. Whereas when you look at the third and the fourth quarter, even in the third and fourth quarter of 2021 calendar year, there was complete normalcy in the economy and there was no COVID impact.
All right, then we are completely out of time on this one. Harsh and I will take your leave. Thank you so much for tuning in. Don't go anywhere. The markets will take the action forward.